In this presentation, we will take a look at multiple choice questions related to governmental accounting, going through the questions and then practicing test-taking skills with them. First question, issued bonds at par for the construction of a building. Receipt of the bond proceeds would result in journal entries in which funds? Either A, Capital Projects Fund, B, Debt Service Fund, C, Capital Projects Fund and Debt Service Fund, or D, neither. Let's go through this again using the process of elimination. Issued bonds at par for the construction of a building. Receipt of the bond proceeds would result in journal entries in which fund? As we record this, note it asks which funds, so now we're thinking about the funds rather than the government-wide type of activity. Funds, quite possibly, if we're talking about governmental funds, being on the modified type of accrual basis. So A says the Capital Projects Fund. Now we issued the bonds for the construction of a building. So we would think that if we were going to construct a large project like a building, we're going to have a capital project fund. So I'll keep that one for now. B says the debt service fund. And again, if you think you're going to have if you're going to make a building, some large building and have a capital project, you think you might open up and have also along with that a debt service fund to service the debt. So I'm going to keep that. Then C says the capital projects fund and debt service fund. And then you're going, well, now both of them sound pretty good now. And then D says neither. So of those three, I would say, well, it's not going to be D. So I'm thinking A, B, or C. Now, this one's a little bit tricky because you would think that if you're issuing bonds, that's debt, and you would think that it would go into the debt service fund. However, the debt service fund really tracks kind of the proceeds needed to finance the bond. So when we take the bond out, typically what's going to happen is we're going to issue the bond, we're going to get the money, and we're going to put that into the capital projects fund because that's what we're going to use in order to spend, in order to make the capital project. Why then would we have the debt service fund? That's where we're going to show basically the financing of the debt. So considering we issued it at par, then the normal journal entry is going to be a debit to cash and a credit to the bond payable on the government-wide type of activities. And there's no other item in terms of a premium or anything like that that we would put to the debt service fund. So since we issued it at par, the full amount that we got is going to go into the capital projects fund. If we had issued it for, say, a premium, then we might have part of the money go into the debt service fund related to the financing of it, and that would be the amount related to the premium. So it's a bit of a tricky question here. The answer is actually A rather than what you might think would be C. And again, the debt service fund's a little bit confusing because obviously when we think about the debt service fund, it doesn't simply mean we have the debt. We're not even really tracking the debt in it in terms of a liability. It's being tracked in the government-wide level. We're tracking the flows and the financing of it within the debt service fund. Next question. Leased agreement for the purchase of a capital asset. Present value of the future lease payments is $676,400, and there is a down payment at the start of the lease of $20,000. The asset is recorded in the general fund at what? Either A, $20,000, B, $676,400, C, $696,400, or D, 0. So let's go through this again using the process of elimination. Lease agreement for the purchase of a capital lease. So we're making a capital lease. We're purchasing a capital lease. Now, when you think capital lease, you're typically thinking, okay, we're buying something possibly large, equipment or something like that. Capital lease means we're going to treat it basically as a purchase as opposed to just a lease payment. Therefore, capital asset on the books usually and related liability, kind of like if we were financing that piece of equipment, asset on the books, related liability related to the financing. So keeping that in mind, present value of the future lease payments is $676,400, and there is a down payment at the start of the lease of $20,000. The asset is recorded in the general fund. So then we want to think, well, where is this being recorded? Government-wide activities, accrual basis, normal. That's what we would, we could feel a little bit better and do what we would kind of expect in the government-wide activities, or fund accounting, which possibly governmental funds has the modified accrual basis, as is the general fund, governmental fund, modified accrual basis. Therefore, we have, it's going to be a little bit more confusing because we don't have then the long-term asset on the books. So if it was the government-wide accounting, we would think, oh, I'm going to record this kind of like I would with a capital asset, and we would have the asset on the books, the liability on the books, and pay the cash. Here, it's governmental accounting. I mean, it's the general fund, modified accrual accounting, And therefore, we're not going to put that on the books. We're not going to have it on the books because it doesn't have long-term assets. It's only got short-term assets. So therefore, it's actually going to be zero because it's in the general fund. It will be on the books, but it'll be in the governmental accounting in terms of the long-term liability as well as the asset related to it. Next question, similar, little different. Lease agreement for the purchase of a capital asset. Present value of the future lease payments, $676,400, and there's a down payment to start the lease, $20,000. The asset is recorded in the government-wide statement of net position at. So now, what's the difference? Now we're at the government-wide statement. That means we're at the kind of entity as a whole. That means we're on an accrual basis, the normal type of thing, and therefore we can kind of think about what the normal kind of process would be. So the normal journal entry, when we put on a capital asset, you would think, well, cash is going down, so I'm going to credit cash for the 20. And then we had present value of the future lease payments is going to be the $676,400. That's going to be some kind of loan or payable. I'll call it just a P for payable. That's going to be $676,400. And then the debit, then, of course, is going to be the $676,400 and plus the $20,000. And that's going to be the $696,400 that we would put this thing on the books for. So we're looking for the $696,400 because that's what the asset's going to be recorded on the books for. So we're going to record it on the books at the $696,400, credit cash for the 20, and then we have the payable, kind of like the loan, as we kind of normally would think if we were to have a capital type of lease in a for-profit organization.